Capital doesn't sit still. It moves across borders, seeking a path from surplus units with excess funds to deficit units that need capital to grow. To facilitate this massive cross-border exchange without getting bogged down by conflicting domestic laws, the global market relies on offshore financial centers. Historically, these jurisdictions offered a very specific set of conditions: light regulatory oversight, minimum exchange controls, absolute maximum confidentiality, and incredibly low tax regimes. The International Monetary Fund recognizes several leading hubs operating in this space. These include the Bahamas, Bermuda, and the Cayman Islands, alongside major centers like Switzerland and Singapore. These represent highly engineered legal environments built from the ground up to provide a friction-free space for international wholesale finance. Operating off the coast of East Malaysia is the Labuan International Business and Financial Center. Labuan functions as a parallel economy. It is geographically situated within a host nation, yet it operates entirely outside of Malaysia's standard economic rule set. The conventional domestic corporate environment, headquartered in places like Kuala Lumpur, is governed by strict local regulations built for the domestic retail population. Labuan answers to a completely different governing body, the Labuan Financial Services Authority. The central tension here is architectural. The goal is to build a legal framework attractive enough to pull in global capital while maintaining absolute separation, ensuring that offshore money doesn't accidentally contaminate or destabilize the host nation's everyday retail economy. This graphic breaks down the legal firewall. Malaysia uses the ringgit under strict domestic authorities. Labuan operates independently with zero exchange controls. Domestic banks serve local residents, while Labuan handles wholesale non-resident transactions. Finally, cash transactions are completely prohibited within Labuan. These exact structural differences form an impermeable barrier. They ensure the offshore and onshore economies can exist side by side without ever accidentally merging. Licenses under the Labuan Financial Services and Securities Act create three pillars. First, banking offers conventional and Islamic finance without retail deposits. Second, trust companies handle corporate administration and mutual funds. Finally, insurance must transact in foreign currency and is barred from domestic business. These highly specialized legal vehicles are designed exclusively to route and manage cross-border wealth, separate from the everyday retail needs of the general public. For decades, offshore markets relied on extremely blunt tax incentives. In Labuan, a company used to pay a flat tax rate of exactly 20,000 ringgit, completely regardless of how much profit it actually generated. That system was dismantled on January 1, 2019, driven by stringent new international tax standards implemented by the OECD. The amended act creates two categories. Offshore trading activities are taxed at 3% of audited net profits. Offshore non-trading activities, like holding investments, are taxed at 0%. To qualify, entities must prove strict tax substantial activity requirements. Empty shell companies are excluded. There are severe carve-outs. Any intellectual property income generated in Labuan is stripped of these benefits and taxed at the standard Malaysian corporate rate of 24%. Personal tax exemptions were also tightened. The old 50% exemption for managerial positions was abolished, although non-Malaysian directors do retain a 100% fee exemption until 2025. The modern offshore advantage no longer relies on hiding money. It requires exchanging audited transparency and economic substance for an ultra-low tax rate. Labuan entities are now permitted to transact with Malaysian residents in ringgit. So why wouldn't a domestic company simply route all its local business through Labuan to secure that 3% tax rate? Previously, Malaysian residents could claim full tax deductions on payments made to Labuan entities. To prevent domestic businesses from eroding the national tax base, regulators engineered a system of strict deduction restrictions. This chart shows the friction. Domestic companies paying interest or lease rentals to a Labuan entity can only deduct 67% of that amount. For other payments to a Labuan business, the restriction is severe, a maximum deduction of 3%. General reinsurance premiums are the rare exception here, retaining their 100% deductibility. This tax friction makes routing domestic funds through Labuan economically inefficient. It protects the integrity of the host nation's tax base while keeping the offshore framework open for genuine cross-border finance. This brings us back to the Labuan FSA. As the central regulator, the authority ensures all entities comply with international standards, balancing its promotional role with strict enforcement. In modern global finance, an offshore center's survival depends entirely on how it is graded by external watchdogs. This graphic shows how Labuan scores across 4 critical international assessments. Through strict enforcement of the Anti-Money Laundering Act, Labuan secured a low-risk jurisdiction rating from both the Financial Action Task Force and the Asia-Pacific Group. By dismantling the flat fee structure and aligning with the 2019 rules, they obtained largely compliant and not harmful designations from the OECD regarding their tax practices. The IMF, meanwhile, verifies the strong legal and prudential framework that underpins this entire market. Without these specific badges of compliance, international banks would sever their ties, and the IBFC would cease to function. Compliance is the literal currency of its survival. When we zoom out, we see the Labuan IBFC for what it really is, a specialized node safely routing capital back into the global network. Offshore financial centers are meticulously constructed legislative engines designed specifically to solve the friction of cross-border finance. The era of the dark, unregulated tax haven is over. The competitive edge in modern offshore banking relies entirely on providing multi-currency capital efficiency that can withstand the highest levels of global regulation.